Alright, hello and welcome to video 3 of the FX Bootcamp Basic Training. My name is David Pegler. I am your drill instructor for basic training. Today we're going to be covering oscillators. Alright, stochastics, MACD, RSI, parabolic, stop and reverse, and a few others we're going to have a look at. Okay, and principally we're going to cover what oscillators are, how we use them in our training, in our trading I should say, and several divergence plays and how to use divergence to work out a weakening in trend, and how to use oscillators to trade in a range. Alright, so stick with me for this video 3. It should be about an hour long, and we're going to learn all about oscillators today and how they work into our trading. Now bear in mind that many oscillators tell us the same bit of information. Alright, principally oscillators are a representation of data that moves between two extremes, oversold and overbought. Now, if you're using 17 different types of oscillators, they're principally going to be telling you much of the same stuff. So be guarded in your oscillator use. I think that's the best piece of advice and disclaimer right out the gate. Alright, many amateur traders have 17 levels of oscillators they have on their charts. CCI, RSI, MACD, stochastics, and you name them. And they're getting crosses. A lot of the time they're getting crosses all at the same time on all of the oscillators. Okay, and it's not, they're going to get, if one gives them a faked out signal, they're going to get faked out on several of them. Okay, so one oscillator or 14, they can still issue false signals, whether they're working, whether you have 10 or one of them. So you need to be able to have the ability to filter them. That's why we discussed support and resistance, speed, Fibonacci, etc. And oscillators are to be built onto those. They are not necessarily your trading strategy. Okay, that's an important concept to understand, is that oscillators are complementary to what we do. They're not the sole trading tool that we use. Alright, and now what they effectively do is show us overbought and oversold conditions in the market. Alright, exiting an area of oversold or overbought is generally an indication of entry. Alright, some samples are RSI, PSR, stochastics, and moving average, convergence, divergence, otherwise known as MACD. Now oscillators, we say, are principally leading indicators. Alright, in the case of MACD and stochastics, we have a very good divergence type role that they play, meaning that as in a downtrend, I'm going to discuss divergence and give you a graphical representation of that, but as we head down, we make a series of higher low or lower lows in price and a series of higher lows on stochastics. You'll have divergence to the upside, therefore the trend is weakening to the downside, and you should be looking for opportunities to buy off support. Alright, that's an important concept to understand. Oscillators are complementary to the other stuff we do. So if you come up to support and you get a MACD cross right off support, you should look for reasons to buy, and even better if it's way overbought. Alright, because then it's coming from an oversold condition. Right, the first one I want to look at is stochastics. It's a technical momentum indicator that compares the closing price to the range moved over a given time. Now the bootcamp settings we use are 853 with a high baseline of 75 and a low baseline of 25. Now these are not default settings. The default settings are slightly less sensitive to price. Alright, these are a little more sensitive, and that's done for a purpose. Here at bootcamp, Wayne, who came up with the methodology, he sped up stochastics and slowed down MACD. Okay, and what that does is tell you two different pieces of information. It gives you a a high sensitivity reading, and then it'll give you a in the form of stochastics, and then the low sensitivity or a filtration type, a well filtered reading in the way of MACD. Okay, and I'll discuss MACD in a minute. stochastic crosses on early indication price may change direction. Alright, once again, if there's nothing in the way of support and resistance from EMAs, Fibonacci, or visual support and resistance, stochastic crosses are simply a consequence of the market. They're not necessarily going to be pertinent to your trading objective. Alright, stochastic lines exiting an area of oversold, overbought may be an indication to enter. And that's what's discussed in this trading example. Okay, the above the high baseline is overbought conditions in the market, referenced by this blue zone here, overbought. Okay, and then below the line is oversold. Okay, and then the yellow zone in between the high and low baseline we like to call our trade zone. And when stochastic crosses and then enters into the trade zone, it affords us an opportunity to enter a trade. Okay, and you can see in this case, stochastics came up into an overbought condition, made a stochastic cross, entered the trade zone, and price subsequently fell. All right, but also note, note there's a few other things going on here. Okay, note how we had, lower highs price action here with a flattening out of the 21 EMA. Now we've spoken about this before, haven't we? In that, the 2155 measures speed in our market. Okay, now stochastics was our heads up, no two ways about it. Because it crossed before price ever fell from an overbought condition. Therefore, it's our little alert to say, hey, we potentially have a trade. But then you start to get a series of lower highs on price. Okay, and you have a little swing low and several, little swing highs here. And remember our definition of a trend. Our definition of a trend is simply an uptrend is defined by a series of higher highs and higher lows, and a downtrend is defined by a series of lower lows and lower highs. Well, you get a stochastic cross pointing that price is potentially going to reverse. Then you get a series of lower highs, and then once you breach this bottom low here, you have now a redefined trend because you have a lower low and a lower high. Therefore, you have a series of lower lows and lower highs, and a new downtrend is formed. Okay, but all predicated on the heads up that the stochastic cross gave you. Then it was just a matter of working out price action to afford yourself an entry into the trade. Right, but also note how when stochastics is in an oversold condition and below the 25 line, the 25 baseline, that stochastics can stay there for a prolonged period of time without necessarily issuing you a exit signal. All right. Although we had a few stochastic crosses here, we didn't really get an exit signal from the trade. Okay. So as long as you're in an overbought, or I should say in this case oversold, you don't necessarily get an exit signal. Okay. And, what we like to do in boot camp is try and match up stochastics, or align, I should say, stochastics with MACD. So when you get a MACD cross down, you're looking for a stochastic cross in the direction of your MACD, and then that's your strongest oscillator signal that you could generate. Alright, leading versus lagging. Oscillators, we like to say, are leading indicators, especially in the case of stochastics. It's very sensitive to price, and it's leading in two areas. In the fact that you have overbought, oversold conditions identified, ahead of price, and additionally, you have the divergence factor in play. Momentum indicators are lagging indicators. So our EMAs, for example, are lagging to price. All they are is moving averages. Averages being the operative word. So they're just moving in response to what price is doing, and averaging out what the candle values are. All right. While the two can be supportive of each other, they're more likely to conflict with each other. we're not saying that one or the other should be used exclusively, but you must understand the potential pitfalls of each. Alright, now, one of the big mistakes that novice traders make is that in a strong uptrend, they will keep selling into an oversold position in the context of an uptrend. Alright, said differently, in the context of a downtrend, they will keep buying into an overbought situation in the context of a downtrend. Okay, so we know that in a quick moving trend, the 21 EMA is dynamic support for us, in an uptrend, and of course price is going to move up and head back down to the 21, then move up, head back down to 21, head back up, a series of higher highs, higher lows, bounce using the 21 as dynamic support. Okay, well, what happens is that novice traders want to keep selling, keep selling in positions where, because they see big red candles and they think that's a license to short. Meantime, the trend is still prevailing to the upside, and you're going to have in this case, you're going to have oversold conditions on your stochastics and MACD in the context of an uptrend. Well, instead of looking for reasons to buy from an oversold position in the context of an uptrend, traders see big red candles and keep trying to short into that momentum that's prevailing, okay, or that speed that's prevailing to the upside. So I'll say it again: when your stochastics are showing oversold conditions in the context of a strong uptrend, do not look for reasons to continue to sell. You need to look for reasons to buy, unless trend has been redefined. Now, a redefinition of trend, remember, in an uptrend, changing to a down would be a series of lower lows and lower highs. However, if you oversold in the context of an uptrend, you need to look for reasons to buy at support or resistance, whether that's dynamic support or resistance or fixed in the way of visual support and resistance. Okay, said differently, in a downtrend, you need to look for reasons to continue to sell in the context of a downtrend. When you overbought in the context of a downtrend, as opposed to trying to look for reasons to buy in those areas. Very important to understand that. So you can use your visual support and resistance, you can use your dynamic support and resistance in the way of your momentum indicators, your EMAs, okay, and then use your oscillators to determine overbought and oversold conditions in the context of that trend that you've defined. Alright, I hope I've made that clear, and if you have questions about that, please post them during the classes to either myself or to any of the currency coaches, and they'll discuss that further. It's a very important concept to understand. You really want to be trading with the trend as much as you can, and it's a case of this, folks. If you have a strong up move, okay, and that shows a full oscillation, if this is your stochastic oscillator like this, okay, and it's made a full oscillation all the way up to the way, overbought area, okay, and then it's returning, and inevitably price is going to make its way back to the 21. If stochastics comes all the way back down to being oversold, and you only have a marginal decrease on price, it's very important at that point that you look for reasons to buy, because you're going to receive an exaggerated move in the opposite direction. If a full oscillation to the downside only resulted in a minor retracement, that's a very bullish sign. It tells you that not very many people at all are exiting this trade to the downside, or even shorting for that matter, and a full oscillation, when it's exhausted, only corrects price marginally. Then you can expect with the next upside oscillation on the stochastics to see a much greater move, much greater response to it in the prevailing direction of the trend. Okay? Once again, any questions to that, please post them. Please ask the currency coaches. I'm sure they'd be more than happy to discuss that. Right, moving on to MACD. Alright, it's a trend following momentum indicator that shows the relationship between two moving averages of price. Alright, the bootcamp settings are as follows: 21, 55, 8. Alright, as you can see on the right hand side. Now once again, this momentum or this oscillator is slowed down. Alright, it's very much slower than stochastics. You almost receive two full stochastic oscillations for one EMA crossover that you find on MACD, but it's done that for a strategic reason, to slow down the EMA crosses, i.e. to give you